Well, hi, everybody. Welcome to today's webinar. It's titled Connecting Continuous Improvement to the Bottom Line. I'm Mark Graven, the host today. I'm a senior advisor with KaiNexus. I'm going to be assisted during the Q&A by Chris Burnham. He's a senior director of lean strategy for KaiNexus. And most importantly, our presenter today is Nick Katko. I will tell you more about him and his books. So he is the president and owner of the firm BMA. Since 2002, he's leveraged his lean accounting experience and philosophy to assist BMA clients in developing, leading, and coaching them in their lean transformations. He served a range of organizations worldwide, different industries, different sizes, manufacturing, healthcare, software, engineering, services, and more. So that kind of sounds like our KaiNexus user base. He was an early pioneer of lean accounting. In the 90s, he was the chief financial officer of the company Bullard. He implemented a complete lean management accounting system as part of their lean transformation, which included eliminating the practice of standard costing. He's a regular speaker at events and conferences. He's written extensively on lean accounting. And again, the Lean CFO second edition is available for pre-order now if you're not the recipient of the copies that we're giving away today. So with that, Nick, let me turn it over to you for the presentation. Thanks again.
All right. Thanks a lot, Mark. And Chris, thanks for allowing me to give this presentation. For those of you who are not familiar with the term lean accounting, it has less to do with the accounting function. And really, it has more to do with the title of the webinar, Connecting Continuous Improvement to the Bottom Line. And sort of the whole genesis of lean accounting, going back to the late 80s, early 90s, when I was the CFO and Gene Cunningham and Ori Fumi were CFOs and Jerry Solomon were CFOs. What we all sort of did is realize that as our companies were going through lean transformations, that we had to do something to improve the information inside the business to be aligned with lean thinking and continuous improvement. And that sort of spurred the phrase lean accounting. That's all I'm going to tell you about the history. Let's talk about what we're going to go over today. First, I want to explain how lean works financially. I call this the economics of lean. There's lots of information, books on how lean works operationally and all the tools and practices. But in order to be able to connect continuous improvement to the bottom line, you got to know how it works financially, which is, I want to say it's different than traditional financial thinking, okay? And I'll explain in a minute. Then talk about the box score, which is a tool to understand the relationships between operating performance and financial performance in a lean company. I'm going to talk about lean cost management. There's always in any business, companies want to manage their costs, and there's lots of sort of traditional or conventional ways that is done. And if you understand how lean works and how it can manage your costs, then it makes life a whole lot easier. Excuse me. Then I'm going to give you some examples. How do you use box scores to measure continuous improvement? Spend a couple minutes on looking at conventional financial analysis and continuous improvement. And I really just want to explain briefly sort of how they need to, if you sort of used, how do I want to say this? It's not about the conventional financial analysis are bad, but you sort of have to adapt them to a lean environment to work. Then we'll wrap up and do some questions. So we're going to talk about numbers. We're going to, we talk about the bottom. Anytime you bring up bottom line, it's everybody puts dollar signs or monetary signs in their head. But what I learned over the years, and I always thought it was just about the numbers, but it's really about thinking habits. And what I mean by this, if you've been involved in any kind of analytical practice, it doesn't matter if it's operational or financial, you use numbers. The numbers drive thinking, and then the thinking drives different behaviors, and you make decisions, and then the decisions that you make change the numbers, and then it just keeps this cycle going. So here's the issue. You have people who, typically management level people, who have been doing certain types of analysis and making decisions for a while using certain numbers. Now we put lean thinking and lean practices and continuous improvement in place, and people get comfortable with the numbers they use, and they want to use the same numbers to do the analysis. The problem is some of the numbers that they use may not be applicable in a continuous improvement environment, or the numbers could drive sort of non-lean behavior. So that's the challenge, really, in connecting continuous improvement to the bottom line, is its thinking habits in companies. Okay, and you'll see what I mean as we go through this, because I'm going to give you some examples. So how does lean work financially? I call this the economics of lean. I'm starting off with this only because I think it's really, really important that how lean works financially is well understood in an organization the same way. You still have, it doesn't matter whether it's a large company or a small company, you sort of have these functional views of numbers and things like that, but all the way from senior leaders down to line managers, everyone in a lean company that is practicing continuous improvement needs to understand this. And it's not complicated, but they just need to understand it. First, continuous improvement. When you improve, the primary, but not the sole, the primary result of any one improvement activity or a series of improvement activities is creating capacity. Or another way to say it is creating time. Why is that? Well, what does continuous improvement do? You eliminate waste. So you're stopping an activity from occurring. So that means that time becomes available. Now, yes, we'll talk about some cost impacts and things like that, but this is the primary output. And what you do with that capacity really determines the true financial benefit. So what can you do with the capacity? You can serve customers better, deliver value. You can also, over time, use that capacity to achieve cost reduction. And again, that is what creates the sustainable financial success. So let me give you an example of how I learned this back in the 1990s when I'm CFO at Bullard. So we set continuous improvement targets. We had performance measures in place, and we said, on average, we want to improve 20% a year. And what we realized is that if we're going to improve 20% a year, we have to sort of fill up that pipeline. So then the marching orders for sales was, you need to grow sales by 20%. So because you're paying for the capacity, your people and your machines, okay, you're paying for them. And how are you going to use their time? This is the reason why people talk about lean being a time-based strategy. Okay, but we have to connect time to the bottom line. The only way you connect it to the bottom line is how you use that time. So then we talk about sort of the cause-effect relationships. And traditional financial thinking is, we set financial targets and we sort of we tell people they need to hit the targets. Best example of that is a budget. You better hit your budget. If you don't hit your budget, you got to explain why. But in continuous improvement and lean, we want to sort of reverse that, meaning the cause of improved improved financial performance is the effect. The cause or causes improved operating performance and improved capacity usage. Another way that I state this sometimes when I'm working with companies, if you want to change the financials, you got to change the physical. It's very difficult to do the financial engineering where you set these targets and say, this has to happen financially, figure out how to do it. You might gain some short-term benefit there, but in the long term, you're not really changing anything. So again, cause and effect. The other aspect is how lean drives financial performance. And there's basically 6 outcomes. You can increase sales without increasing your fixed costs. That's the idea of having that capacity and producing and selling more. You get the revenue, you get the contribution margin, but your costs don't increase. You can reduce your fixed costs as a percentage of sales. And we'll talk about this a little more later, but labor, your full-time employees, that's a fixed cost. That's not a variable cost. So if you are improving and creating capacity and not having to hire people, for example, your labor costs as a percentage of sales will go down. There might be opportunities to reduce variable cost and improve contribution margin. As I mentioned already a few times, you can increase capacity without paying for it. That's the beauty of continuous improvement. You can improve performance and increase capacity. You can improve cash flow. The best example of improving cash flow is from manufacturing, where lean thinking drives down your inventory and you have more cash. So you think about this as sort of like the 6 possible outcomes of continuous improvement. So how do we measure this? This is the idea of the box score. And, we developed box score years ago, and it really embeds the economics of lean, and you use it as a tool to drive thinking in terms of analysis and decision-making. It gives visibility and insight. There's 3 components. What are the performance measurements? Lean performance measurements that will measure operating performance improvement. We look at what we call a value stream income statement. How much revenue and is a value stream generating? What are the actual costs? Now, I realize certain value streams in certain industries may not generate revenue, but they still have costs. And then the third piece is capacity. We talked about how much capacity are we creating. So you can see that, this becomes a tool to use to drive the thinking and to connect continuous improvement to the bottom line. So brief review, okay? Lean, basic lean performance measurements. If you're involved in continuous improvement or lean, you have a lot of familiarity with these, but I'm not going to go over them in a lot of detail, but it's the combination of measurements that measure improvements in delivery, quality, lead time, productivity, cost, safety, and morale. And that lean operating practices and continuous improvement activities will make all these categories of measurements positive over time. Now, capacity, this is sort of like the new animal in terms of numbers. And again, think about lean as a time-based strategy. So if we want to measure improvement, the measurable impact of improvement, it's really important to be able to measure capacity. And we want to, and this is not what are the capabilities of the process. There's sort of like ERP systems that can measure how much availability you have. It's not about that. It's looking at it from a lean viewpoint. So how much time on average do we spend on creating value? That's productive capacity. How much time do we spend on everything else, which is non-productive? And then how much are we creating because of improvements? I mean, if you're going to do continuous improvement activities and you're creating time, you want to be able to say, this is how much we're creating. And then if you look at the whole basket of improvement activities over a company, throughout a company, this becomes a very strategic number because senior leaders need to have a plan. What are we going to do with that? Goes back to that example of creating 20%, improving 20%, and saying we're going to sell 20% more. So it's really important to be able to measure this. Now, you'll see the link at the end of the webinar. I have a whole recorded webinar that I did last year on capacity. If you're interested in learning more, I could spend the whole hour on it, but don't have time. Then there's the value stream income statement. Now, this is an internal management tool. Okay, it's not, it serves as a basis for financial reporting, but it's not something that outsiders see. And all we're really redoing here is reorganizing your income statement by value stream. Okay, what are the value streams? What's the revenue? What are the actual costs of the value stream? And these are the actual costs for the period. We separate out all non-value stream costs. We don't want to do cost allocations and things like that. We want to generate a value stream operating profit. And then in order to reconcile to our regular income statement, we have to do some accounting gyrations there. But the real number, the real important number there are the value stream profit numbers. So now with the box score, you can do these connections and understand the relationships. All right, so there's the fundamentals. Now let's look at cost management. And think about this as a series of practices, okay? Again, I'm giving you a high overview of this. There's a lot of cost management practices in companies. The best one, as I mentioned, is the budget. But there's lots of companies sometimes I think are overly obsessed with how many ways they look at costs. You have cost allocation systems. You can slate, cost profitability per customer, profitability by market, profitability by business line. There's just all kinds of ways to slice and dice this. But how does lean make this job easier? First, we want to define costs. What's variable and what's fixed? So a variable cost changes directly with short-term volume changes. So in manufacturing, that's your material. You sell one more item, you incur that material cost. If you sell fewer items, you incur fewer material costs. That's variable. Fixed costs, they don't change. They don't vary with short-term volume changes, and they are influenced by management decisions. The best example, as I mentioned, is your full-time labor force. That cost is fixed. You pay those people a certain amount to come in every day and work, no matter what they do. All right. And you decide to hire people, you decide not to replace people. So there's a management decision that's made. And in lean thinking, more costs are considered fixed in lean organizations. Now, this is counter to a lot of conventional cost allocation systems. So, for example, a product cost in manufacturing or a cost per patient in healthcare. What that cost allocation method does is it takes fixed costs and makes them appear to be variable, cost per patient. Okay, most of your costs in healthcare are fixed. So you try to, if you're looking at cost per patient, it's really hard to change the numerator because your costs are fixed. Now, the denominator, if you can see more patients, then that will drive cost per patient down. But people don't think this way. They think that all the costs are variable. So we want to define costs properly. The other important thing is to understand how lean achieves cost reduction and how continuous improvement does. One, actual cost savings. Okay. That means you see in the short term your expenses go down. Then there's cost avoidance, which means, well, we might not increase costs in the future. Then when you start connecting this back to continuous improvement and capacity, creating capacity, there's more cost avoidance than cost savings. And I know a lot of companies like to monetize time savings, where they say, we save this much time, so therefore we're going to put a dollar sign in front of it and say, this is how much we saved. But you don't see that in the short term. Now, in the long term, you may see it because of this, the way you measure. Okay, that's why I emphasize fixed costs and measuring it as a percentage of sales, because the fixed cost will not increase at the same rate that your sales does. Now, if you have variable costs, you can look at contribution margin, which is sales less direct costs. I strongly suggest that you avoid using a cost allocation method to try to measure improvement. And you have to be very careful when you're using the external financial statements. So these are the ones that get reported to shareholders and owners, and they're compliant with generally accepted accounting principles. The problem there is that, and I'm a former CFO, I'm still a practicing certified public accountant. What accounting needs to do to make the financial statements compliant for external reporting purposes, it can sometimes mask what is really going on with costs. So that's why it's important to have a proper lean performance measure of cost reduction over time. So let's just look at labor as an example. If you think about the drivers of cost, there is a variable component of labor cost. That's your overtime. That's any temporaries, contract labor. You think of overtime, you have to relate labor to capacity. Overtime, you are paying for temporary capacities. So again, why do you have overtime? If you can create more capacity, you can possibly eliminate the overtime. That will achieve a short-term cost reduction. Your fixed cost, full-time employees. Look at that as your permanent capacity. Okay. And again, if you need more capacity, you're going to hire people. But the shift in thinking is that your labor cost is how much you're paying for capacity. Capacity requirements is based on the demand and the level of waste in the process. So you could hire people, or you could improve, eliminate waste, and not hire people. What's better? Now, if you're involved in continuous improvement and lean, you know the answer to that question. But you think about labor cost and the traditional thinking. It is an expense. In many companies, it's the largest expense. So what do you try to do in conventional financial thinking? You want to, control and reduce your expenses. But from a lean viewpoint, your people are the most important asset. Okay? They're a resource. Besides doing the work, the people are going to do the thinking. They're going to do the problem solving. They're going to do the continuous improvement. That's not going to be done by any kind of software system or reading a book. It's about people solving problems. So therefore, you really have to get the company to stop thinking about how many people do we have and how much is it costing us, and think about how are we using our people's time. And you know what? It's not their fault that there's a lot of waste in the process. And they probably know it, and they probably can eliminate it if we give them the tools and practices and authority to do so. So what are ways to achieve labor cost reduction? So here's some actual savings. Reduce the overtime. When people leave, don't replace them. You have capacity, other people can get the work done. You can promote internally, backfill in a lower paid position. If you outsource operations because you don't have the capacity, you might be able to bring it in. I've seen all companies do all of those. In fact, when I was the CFO at Bullard, we applied lean thinking and continuous improvement in the accounting function. And over the course of a few years, we reduced our staff by about 40%. And we were a smaller family-owned company, but we reduced our staff by 40%. Some people left. We just didn't replace them. And this was a team decision. It wasn't me saying, no, we're not going to do this. The first thing we thought of as a team is, could we get this done? A couple people in accounting then applied for other jobs in the company. And again, we didn't replace them. Cost avoidance. So, if you have capacity in this value stream, you don't have capacity in another value stream, you can move people. You can do cross-training and give people more skills and ability to do more work. And then if you have temporary available capacity, assign them to temporary assignments. So that's how lean cost management works. So let's talk about measuring continuous improvement. I'm going to give you some examples, okay? And I'm going to sort of talk about this through the box score, okay? I'd like to thank Mark for giving me some of these. I asked Mark, I said, hey, can you give me some examples of continuous improvement that I could use that are, that may have been used by some of the listeners? All right, so let's look at sort of what happens over the course of time. You make a few improvements where you're improving delivery, quality, and flow. So your on-time shipments get better. Your quality number first time through gets better. Your flow, your days of inventory, the dock-to-dock days is reduced. All good stuff. With a box score, If you're looking at actual costs, you can calculate what is the direct financial impact of these events. Now, in this case, the material cost goes down. Why? Less inventory, that means less material. Better quality means less material, less scrap. Again, direct financial impact. But the real benefit of using a box score is, hey, we've done these 3 improvement events and we've basically doubled the available capacity of the people and the machines. The employee capacity available capacity went from 19% to 37%. Machines went from 15 to 29%. That's the direct measurable impact of these events. It's all quantified. Then the question becomes, going back to the economics of lean, what can we do with that capacity? So what this company did is they realized that they could increase sales. They had the demand out there. So what's the impact there? Well, revenue goes up. The material costs go up because it's variable. Our conversion costs, which are our production costs, they stay the same. In fact, they went down a little bit only because we can cut out some overtime. Value stream profit goes from 104,000 a month to over 172,000 a month, or from 31% to 40%. And this is the benefit of continuous improvement, especially when you can use any of the created capacity to sell more. You generate revenue, your variable costs go up, your fixed costs don't go up. So the incremental profit is a whole lot greater. It's basically your contribution margin. And then if you look up top, you can see the performance measures even get better. So now I'm going to give you a couple other examples. And this is more, I don't really have numbers here. This is more about thinking and using the box score to how to think through it. And I've sort of just did this on my own. If you went through this exercise, you might think a little differently than I do. So this is an improvement event in healthcare, where the surgical instrument flow from the operating rooms to the instrument process and back was reduced from 10.6 hours to 3.6 hours. So 7 hours were picked up. So what's the impact of that improvement event? Well, productivity is going to go up. It's going to get better. The lead or the process time is going to get better. You're going to eliminate some non-productive capacity and pick up available capacity. And in healthcare, especially in hospitals, surgery, that's the primary profit center of a hospital. So if you can perform more surgeries, then the financial impact is going to be more revenue. You're going to incur more variable costs. Some of your other costs may go down, but overall your profitability is going to go up and your productive capacity is going to go up. So again, you use the box score to think this through. Changeover time. This is always one of my favorites because it has such a dramatic impact on operating performance and financial performance. So if you can reduce changeover time, in this example, from 4 hours to 15 minutes, what's the immediate benefit? You improve productivity, you improve delivery, you reduce your inventory, and you reduce your lead times. Okay? Great benefit operationally. You also create a whole lot more capacity. And then if you can apply that capacity to sell more, you're going to generate much more contribution, much more value, much more profit. But again, this is a very good example where you're saving 3.75 hours per changeover. If you say, well, 3.75 hours per changeover multiplied by some rate, some machine rate or something, this is how much we're saving in cost. That is understating the true financial benefit. The true financial benefit of reducing changeover time is contribution margin, which is more than reducing costs. Same thing with quality. Installing an error-proofing machine. It reduces the defect rate from 2.7% to 0. What's the impact? As you can see, we have positive impact in all performance measurements, and we're creating more capacity. Why? Every defect you make consumes time. Fewer defects, you have more time. How would that impact financially? Well, if you can't sell anymore, your variable costs will go down. You'll have less material cost. So you will see some benefit. Now, again, much like the changeover example, if you can sell more with that, if you can sell more and use that capacity, then you'll pick up revenue. A point I want to make here is, you can look at one improvement event in isolation, and you might not be able, the total financial benefit may not be clear. But if you look at all of the benefits and how much capacity is being created, that's when you really see the financial impact. So here's a final one, getting wireless headsets and customer service. It improves the ergonomics and staff satisfaction. Also, shorter hold times for customers. So what do you get out of that? Improved productivity, safety, and morale. Okay, is there a financial benefit? I don't know. Sometimes these are difficult. These are hard to figure out. But if you have a box score, you can go through it. Now, what I would say here is, in the short term, there may not be any financial benefit, but in the long run, if shorter hold times for customers means customers are going to buy more, there could be a financial benefit. All right, just to wrap up here, then we'll get to questions. When you look at some conventional analyses, like return on investment, net present value, internal rate of return, they're good, fundamentally sound tools, but they all assume a cash outflow. Return on investment, you spend some money, you get a return. What's the return? It's a percentage. Payback period, same thing. But when continuous improvement is basically creating capacity, there's no cash outflow. All right. And you don't want to, and then even what's the benefit? That's where you have to sort looking at the economics of lean to understand what the benefit is. I always like to say, when it comes to continuous improvements, it should be return on effort rather than return on investment. I talked a little bit about cost allocations. Okay. They basically allocate a fixed cost, avoid using. Short-term impact on an income statement. Okay. You may not see it. And then monetizing time savings. Okay. If you put a dollar sign in front of a number, people think, especially when it comes to a company, people think, oh, I'm going to see that on the financial statement. It's sort of natural thinking, but it may not be. Okay. So that's why, some companies do soft savings and stuff. We talk about, again, capacity and time, and then what are you going to do with that time? So, some practical advice. Your accounting people, your executives, they need to experience continuous improvement to understand what it is. They need to understand continuous improvement will lead to financial improvement, and it's not the other way around. Integrate the economics of lean and box scores into analysis and decision making. And with continuous improvement, really distinguish between short-term and long-term. Short-term impact must be actual, must be realized. Long-term, you can see a lot of financial benefit through continuous improvement. Going back to the first slide, the numbers drive the thinking. We have the box score, drives the thinking of understanding lean relationships. The behavior, PDCA, continuous improvement. The decisions, we're trying to improve economic value. It's not just about cutting costs. It's about growing revenue, improving contribution margin, increasing capacity, improving performance, improving cash flow. It's all of that. And any event that makes a positive impact on any of those outcomes is good. So, before I turn it back to Mark, if you want to learn more, first of all, I'll offer any of you a 30-minute chat about this webinar. Just email me if you have questions, you want to talk a little bit more, and that offer doesn't expire. Just email me and say, I attended the webinar, I'd like to talk. You can learn more about lean accounting through our website. I do monthly webinars, blogs, online courses, and certification. In fact, I have a webinar tomorrow morning. YouTube channel, there's the link there. I record all of my webinars, post them on YouTube. So, for example, if you're interested in capacity and want to learn more, there's a capacity webinar you can watch. And then, Mark talked about the second edition of the Lean CFO. That's going to be released in early February. I set up the book launch event online. It's February 10th from 2 to 3 Eastern time. Registration is free. There'll be specials on the books and things like that, and that's where you go to register.
Future webinars. If this is your first time attending, thank you for being here. We'd love to have you join us. We do these monthly. You can register to get notified of future webinars at kinexus.com/webinars. Our next webinar registration will be open soon. It's going to be February 23rd. The title, or the topic is Habits and Continuous Improvement. Our CEO, Dr. Greg Jacobson, and our customer marketing manager, Morgan Wright, are going to be presenting that February 23rd, 1 o'clock Eastern time. We also invite you to check out our webinars on demand library. You can find a big button on the KaiNexus webinars page, or you can find our YouTube channel for all of that. And this one will be posted there as well. Next slide, please. We invite you to check out our blog at blog.kainexus.com. And then next slide. Also, please check out our podcast. You can find it at kainexus.com/podcast, or you can search any of the major podcast apps or directories. The audio of today's session will be available in the podcast feed if you want to go back and listen again or share it with colleagues. And then we will go into Q&A. You can see Brian's email address and website there, maskell.com. And I am going to turn the Q&A over to Chris Burnham. Thanks for doing this, Chris.
Nick, thank you so much. This conversation and webinar was born out of Mark and I having a discussion at a KaiNexus event, talking about how difficult and challenging it is sometimes for lean professionals and lean people to convert lean problems into business problems that executives in traditional operations and finance leadership can understand. And we have a whole bunch of questions that kind of dive into that. And the first one I'm going to start out comes from Stephanie Hill. And she says, in practice, does the box score rely on leaders over value streams or versus by location?
Well, we recommend that box scores are posted or done by value stream because sort of from a lean accounting viewpoint, value streams are your profit centers. If you think about that, what's the job of a value stream? It receives an order and then it delivers on that order, and there's going to be revenue and costs associated with it. So that's the way we look at it.
Okay. The next question we had, it was really a comment from Dan that spurred a question, and that is another example of lean cash flow improvement in non-manufacturing is doing Kaizen events around collection of delinquent accounts receivables. What are your thoughts about doing this kind of work?
It's great. One aspect, I pretty much focused on the management accounting side of lean accounting, but there's another whole practice area of improving accounting processes. And yes, if you can improve the collection process, you're going to improve cash flow. And ideally, if you can prevent, in terms of like accounts receivable, if you can do everything right and the customer can do everything right, maybe you won't have any more collection problems.
There were a lot of questions that were similar, so I'm going to group them together here. And it was, how do you start the discussion with traditional finance departments to move from department-based income statement budget to a value stream-based income statements? Who owns the value stream budget if there's no owner of the value stream? And does this require restructuring of the organization?
Oh, okay. So let's do value streams first of all. Value, sort of value streams, it's more of a lean thing than a lean accounting thing. Creating value streams or understanding your value streams and then managing your value streams does not necessarily require a complete restructure of the organization. What you really want to do is have, at a minimum, have strong value stream teams. Okay, that's number one. I forgot the other part of the question.
It's like, who owns that value stream budget if there's no owner of the value stream?
Well, somebody, there has to be a value stream manager or a team of people that manage the value stream. Has to be. I mean, you can't create a value stream and not have it being managed by people.
Yeah.
So, I always say the value stream team owns the value stream box score and the value stream income statement. But, a value stream income statement, really, it can be influenced by sales and how many orders are being brought in and things like that. So your value stream team is more than just operational. You would want finance represented. You would want, for example, sales represented on the team. Okay.
All right. This is a great one. How do you help managers and supervisors and executives move off of the cost per blank, which
Yeah.
seems like it's prevalent in a lot of organizations?
Oh, yeah, it is. Yeah. Well, the first thing you have to do is introduce the new numbers and demonstrate how they're used and how they lead to better decisions. Okay, most people involved in continuous improvement and lean know that like a product cost is a bad number to use. They sort of know that and they don't like to use it. But it's very difficult to sort of go to accounting and say, oh, we got to stop using that. This is what my webinar is about tomorrow, by the way. They have their reasons for using it. So you can't sort of just point fingers and say it's bad. So introduce them to the new numbers and the benefits. And then from there, it's really about in applying continuous improvement to how do we sort of de-emphasize those cost allocations.
Okay. You mentioned that general accepted accounting principles, adjusted numbers can cause problems. Obviously, you still need to report in GAAP in some situations. How do you manage GAAP numbers and then lean accounting numbers in the same space?
Well, if you have box scores and value stream income statements, if you focus on improving the box score, it will show up in the externally reported financial statements. However, it may not show up immediately. That's the whole thing. Okay.
No, I'm sorry. Go ahead.
And it's really, this is one of the, I think is one of the more important roles for accounting in a lean company, is that they have to have that knowledge. They have to understand box scores. They have to understand what continuous improvement is doing. They don't have to be experts in how to do it, but they need to be able to then interpret. And they need to be able to say, here's what's going to happen in the short term. Here's what might happen in the long term. And that's where those analysis come in. And that's where, for example, accounting would say, okay, senior leaders, we're creating all this capacity. What are we going to do with it? I need to know so that I can do my financial model.
Okay. And I think I know the answer to this, but Andrew asks, are box scores a part of regular monthly management reports, or are they more CI project specific?
The box score is a tool for regular management practices. And then for major improvement events, you would want to sort of take a box score and say, okay, what's the improvement event? And sort of filter what you expect to happen or what happens in the improvement event through the box score. How is it going to impact the box score? So it's both, but it's not, you don't have a specific box score for a specific improvement event.
All right. You mentioned a minute ago that you have a webinar tomorrow on a different topic. So Dan says, given him a CPA, he'd love to find that webinar. Where can he find that from you?
Go to the website, maskell.com, scroll down on the homepage to events, and you'll see the event, tomorrow's webinar, and you can click on the event and then register.
Okay. Another question that we had was, you mentioned it's really important to get cost allocations out of the system and the box score. And so one of the questions was, in something like a shared services group or something, you just hold those off in their own column, is what I saw. Is that correct?
Yeah. You would, again, any cost allocation is subjective. There's some element of subjectivity. How are we going to assign costs? Okay, you got to make it's not scientific. And so you can always argue about, well, we can change the way we allocate. So when I'm working with companies, what I always say is, who is responsible for the actual costs? What function? What department? That's where you have to put the costs to drive the behavior. Like even in shared services, you could do a box score in shared services. What are the actual costs, and what's the performance, and what's the capacity, and how much waste are we eliminating? Rather than taking a shared service cost, assigning it into, for example, a value stream, and then telling a value stream team, oh, you have to control that cost. They have no control over it.
Okay.
get passionate about this stuff. Especially
I
cost
know
allocation.
we're coming up here on the time here. I think we have time for one more question, and that's in your experience, do finance and quality improvement professionals have to partner to create these types of financial analysis? Kind of how does that typically work out?
You want accounting and finance to work with the users, the people that are going to be using this information. Okay, they're the customers. So let's work together to build box scores and analysis. And when I'm working with a company and we're doing a lean accounting pilot, that's the first thing we do is we put the team together and the team works. And it's amazing. This is the interesting part about it. It's amazing how both sides learn from each other. When they start to sit down and talk about things like creating a value stream income statement, it's like, oh, I never knew that number. I never knew this was in this cost or this was in that cost. And it's really interesting. And you build the collaboration and consensus. That's what it's all about.
Mark, Nick, thank you for answering our questions. Mark, you want to take it from here?
Yeah, well, Chris, thank you for doing the Q&A. Nick, thank you for the answers. Thanks to everyone in the audience for the questions. And, thanks also for the presentation here, Nick, today. We're going to send this out, and we appreciate everyone who attended. We make sure all of our customers get their eyes and ears on this presentation if they weren't able to attend live. So I want to thank everyone for being here again. Thank you to Nick Katko. Congratulations on the near release of the second edition of the Lean CFO. I hope people will go learn more about Nick and their work on their website, www.maskell.com. Nick, anything you'd like to add before we sign off?
No, thanks a lot. I enjoyed this. I enjoyed the questions, and look forward to seeing some of you online in the future.